Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Long options, you get long gamma. Short options, you have short gamma. The benefit of being short an option, though, is that you have time decay, or what's called theta, working for you. So the change in the option value for every 1 day decrease in time remaining until expiration. So if I had an option that's trading 350 and it had negative 20 cent theta, that means that if someone was long that option and nothing happened that day, the next day, theoretically, that option should open at 330. Of course, that benefits sellers. If you think about it, best friend of a seller is the theta. The best benefit, for the buyer is going to be the rapidly changing delta or gamma. Vega measures changes in the volatility. So the change in the, and I call it the implied volatility because I think that's the best way to measure what the market's expecting. I mean, every day we price options at the ISE. Anytime the market's open, you can actually go to your broker's site. They're going to have a calculator there, and you can look at the implied volatility. There's a great site called livevol.com. You can do that also. So for an example, if an option had a vega of 25 cents and its theoretical value was 250, if the volatility were to increase by, I actually put 1% here, but it's really 1 unit. So 1 unit change, the option would have a new theoretical value of 250 plus 25 cents. This is not including any time decay that might occur. Row measures changes in interest rates, the interest rate differential. So I would look at the base currency versus the quote currency and see what the interest rate differential is. So for example, the U.S. has pretty much the lowest rates, except maybe against Japan. That's going to affect the calls and puts. If the base currency has higher interest rates, the puts are going to reflect that by higher values. If the base currency has lower interest rates, the calls are actually going to be higher relative to the put. So the interest rate differential is very, very important. So let's talk about delta, gamma, and theta. They are very closely interrelated due to what's called convexity. The greater the convexity, the greater the gamma for options allows the delta to change more rapidly. So the delta of the option changes if the underlying changes enough during a certain period of time. So the price movement is measured in delta. That's sort of our first stop when we're looking at the option Greeks. How much, if the underlying moves a point, let's say I'm looking at the U.S. dollar against the Canadian dollar. Close to, for example, I'm saying 104. So if I have a 104 call, that delta might be about 0.50, might be maybe a little higher, 0.51, whatever. Roughly about 50%. So if the U.S. dollar against the Canadian was to move up a whole point, that call option should move up about 50 cents. It means the put option should move down about 50 cents, roughly. Of course, and as I just mentioned, I was looking at illustrating the at-the-money options. You could quote or price the in-the-money options. They're going to have higher deltas. The out-of-the-money options are going to have lower deltas. The greatest gamma is going to be at-the-money options. Why wouldn't you want to always purchase maximum gamma? Because then you get more time decay, or theta. What is gamma? Well, again, another way to look at it is convexity as it relates to FX options. Measure the curvature in the relationship between the FX exchange rates and the FX options. As I mentioned, this convexity is not linear. So when you're purchasing gamma, you're purchasing leverage. The potential for an option to change pretty quickly. If the underlying asset does not move, the purchase of the option, the purchase of leverage depreciates. That's called theta. That benefits the option seller. Gamma manufactures delta. Gamma gives the option acceleration, but with a cost. Think of the metaphor of the 4-cylinder car versus the 8-cylinder car. Which one has better acceleration? Well, the 8. The problem is that its theta is higher. Well, that, of course, is called gas mileage. Gas mileage is poorer. So when you're buying, if you're always buying at-the-money options, you're getting more gamma, but with a cost, the theta. Different options have different gammas. Options have the most gamma at the strike price on expiration day for out-of-the-money options. And in-the-money options have much less gamma. Theta and delta are also dynamic. Everything's changing. We know this. So if you're looking at that, trying to be getting a practical use of delta, gamma, and theta, delta is the most appropriate value that the option should move given a 1 unit move in the underlier. In the money options, high deltas. Let's just say that in the money option might have, for illustrative purposes, an 80 delta. The at the money might have a 50 delta. The out of the money option might have a 20 delta. So which one's best to buy? There is no best. The in the money option is going to cost more, but it's going to move more like the exchange rate. The out of the money option costs a lot less, but it won't move all that much until it gets closer to the strike price. Gamma is the approximate change in the delta of the option given a 1 unit change in the underlier. And theta is the approximate time erosion per day for the option. So if I can graph positive and negative gamma, well, if you look at that smile to the left, what that's saying is that my delta is going to actually change positively to the right as the exchange rate moves up. If I'm long, let's say the U.S. dollar Canadian, if I'm long a call, my deltas are going to go up, giving me, that's from the call perspective. And if I buy puts, the same thing, my deltas are going to go up. And so I see that, and so my values would go up. Negative gamma, what you're seeing here is if the asset starts to go up or down, and what it's telling me is that my option is now getting further and further in the money, and my portfolio will be dropping if I didn't hedge it at all. So, of course, my sweet spot for negative gamma would be right where it is today. For positive gamma, that's the worst possible spot. As I mentioned, positive gamma has negative theta. Theta measures how much an option loses per day, and theta is also called time decay. Long options have positive gamma but negative theta, the cost per day of holding the option. Gamma, from a practical sense, well, you add or subtract the gamma, and I gave you an example of that. Remember the 52 delta, and then the 7 gamma gave me my 59 new delta. Long calls and long puts have long gamma, and short calls and short puts have short gamma. Gamma is also increased at the money if volatility decreases in the marketplace. Vega, when we're trading options, we're trading uncertainty. So the greater the perceived future uncertainty, the greater the options premium. Options will increase in cost when volatility is actually high or when volatility is thought to be heading higher. Options will decrease in cost when volatility is actually low or when volatility is considered to be going lower. And that's what we've seen over the last 9 or 10 months, although volatility seems to have found a level where supply meets demand, at least in the last couple of weeks or even couple months.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.